Good morning or good afternoon, depending on what time it is for you. I would like to welcome each of you to our webinar series. In the email blast you received, you're presented with 4 different presentation options. I encourage you to view each one of them as they will provide you with some great insight regarding changes brought about by the CARES Act and other recent tax legislation. I only wish this was being presented at a better time for all of us. I do hope that each of you and your families are safe and healthy. My name is Ray Gallagher, and I'm a tax partner at Levine, Lofgren, Morrison, Engelberg. This is one of a 4-part presentation to help you navigate through the changes and new legislation that revolves around the CARES Act. We have divided it into 3 technical presentations and an economic overview presentation by Bob Lofgren. One final note before we get started: keep in mind new legislation and much additional guidance is occurring almost daily. Some of the material covered in our presentations may have been changed or clarified since we produced these webinars. We are here to help you navigate through all of these, so please feel free to reach out to your Levine, Lofgren, Morrison, Engelberg contact for further clarification and assistance. For this webinar on the Paycheck Protection Program, SBA loan, and state and local relief, we have Brian Surratt and Jeff Ewan. Brian Surratt is a tax partner with the firm. He has over 28 years of public accounting experience, earning his bachelor's from San Diego State, and is very upset his Aztecs cannot play in this year's NCAA tournament. He also thinks they could have gone far in the tournament. He also received his master's from the University of Florida, Gator Pride. He works with many closely held businesses and their owners. When not working, he enjoys hiking, golfing. He's not very good at golf, but he enjoys it, and family time, which he is getting plenty of right now. Along with Brian, you will hear from Jeff Ewan. Jeff earned his bachelor's and master's from Miami University. Although Jeff enjoys the sun and beach, this Miami University is located in Oxford, Ohio. He spent his first 6 years working for Ernst & Young in their Cleveland office. He has been with Levine, Lofgren, Morrison, Engelberg for over 9 years and works with many of our high net worth clients as well as closely held businesses. Please enjoy this presentation.
Hello. My name is Brian Surratt. I'm a tax partner at Levine, Lofgren, Morrison, Engelberg. Today's webinar is on the SBA loans available and various other stimulus package programs. In particular, I will be discussing the Paycheck Protection Program loan, also known as the PPP loan. By now, most of you have heard about this program, and many of you have already applied for this loan or are in the process of applying for this loan. When Congress enacts a bill such as this, it is very technical and it contains many hundreds of pages trying to define what is exactly meant. It also contains many references to other sections for additional definitions and clarifications that are hundreds of pages in length as well. Needless to say, trying to decipher some of these bills is a tedious task. I am presenting this webinar in what is hopefully a user-friendly format so that a layperson or small business owner can understand what this program is about and how it is intended to be used. The Paycheck Protection Program was part of the 3rd stimulus program. It initially provided $349 billion. But there were worries that the program was oversubscribed and would run out of funding. Early on, the President and Treasury have indicated they would request additional funding this amount was depleted. Currently, there is additional legislation, what I call Stimulus 3.5, being negotiated by the 2 sides in Congress that would add billions of additional dollars in funding to this program. It's also going to clarify some existing rules, and it's going to add some other rules as well. I don't want to discuss too much what could be potentially in this package, as it is only proposed at this point, and negotiations are still occurring. So the final outcome could end up completely different. The main thing here is that almost certainly there will be additional funding for this program. This program was designed to allow employers affected by COVID-19 to continue paying their employees during the initial shutdown phase of the coronavirus pandemic. If we remember back, at the beginning of the year, the economy was humming along just fine. And then the coronavirus pandemic came into play, and the government started shutting down sections of the economy. Some businesses were told to completely shut down. Customers were told to shelter in place. So many small business owners began to worry about cash flow and what to do with their employees. Should they continue paying their employees? Should they lay them off? Should they pay their rent? The government knew that this was a temporary measure, and they knew that they didn't want employers to completely shut down their businesses. So they came up with this paycheck protection program, which is really kind of nifty. It allows 8 weeks of payroll, 8 weeks of rent, and 8 weeks of utilities. So who is eligible for this loan? Well, small businesses and nonprofits affected by the shutdown. And what can the proceeds be used for? Well, the loan proceeds can be used to cover payroll costs, pay rent, pay the mortgage interest on your business loan, and utilities. Is a portion of this loan forgivable? Yes, to the extent the loan is used for the above costs, it is forgivable, as well as the accrued interest on the loan. Other features of this loan are that there are no personal guarantees required to get this loan. There are no prepayment penalties, so you can pay this loan off whenever you want. There are no guaranteed fees that you have to pay to the bank, no yearly fees that you have to pay to the bank. Any fees required to be paid to the bank will be paid by the SBA. The program is essentially divided into two distinct pieces: getting the loan and then using the proceeds of the loan. In getting the loan, you need to determine if you qualify. Then you need to calculate the amount of the loan you qualify for. Then you need to fill out the appropriate paperwork, apply for the loan. A caveat here is, remember, you are applying for an SBA loan, and do the fast tracking by the government to get the money in the borrower's hands as quickly as possible. The onus is on the borrower to make sure they are qualified and have complied with the rules. The banks have been given a free pass here and are going to rely on your information without too much inspection. Okay, then using the proceeds. Once you get funded, there's going to be an 8-week period for paying the qualifying expenses. During this 8-week period, the borrower is going to need to prove the money was spent on qualifying expenses. We suggest that you have a separate bank account. Have the money be funded right into this bank account, and then use this bank account to pay all the qualified expenses during this 8-week period. If you don't have a separate bank account or can't get a separate bank account in the time period needed, it's very important that you have clean accounting. Any amounts not forgiven will roll into a 2-year loan with a 1% interest rate. Payments are deferred for 6 months and up to 1 year. Interest will continue to accrue during this deferral period. Okay, do you qualify? Well, are you a small business with less than 500 employees, or qualify as a small business under the Small Business Act? Are you a 501c3 nonprofit? Are you a 501c19 tax-exempt veterans organization? Were you in operation on February 15th, 2020, and had employees that you paid wages to and paid payroll taxes on? Are you an individual who operates as a sole proprietorship or as an independent contractor? Or are you a self-employed individual? And is your business located in the United States? You are ineligible for a PPP loan if you are engaged in any activity that is illegal under federal, state, and local laws. So cannabis businesses are not going to be able to qualify for this loan. If you're a household employer, say you pay wages to nannies or housekeepers, well, you're not going to be able to qualify for this loan as well. 20% or more owners of businesses that are currently incarcerated or on probation or parole, or have been convicted of a felony within the last 5 years, you're not going to be able to qualify for this program. Also, if your business, if you've ever attained an SBA loan, or you currently have an SBA loan that's delinquent, or you've defaulted on an SBA loan in the last 7 years, you're not going to be able to qualify for this loan as well. Okay, who counts as an employee? Well, full-time and part-time employees are included in the count. Includes employees from a temp agency, a professional employer organization, or other leased employee operations. If these employees are considered your employees, then you would be able to include them in your count and use them in qualifying for your loan amount. How do you determine the number of employees you have? Well, you take the average number of employees per pay period of all the pay periods for the preceding 12 calendar years, your look back period, or however many months you've been in business is less than 12 months. Affiliated groups must be considered with respect to the 500 employee limit. So if you have a complex ownership schedule and think that you might be subject to the affiliated group rules, then you need to look at this to make sure you can still qualify. Since the funding is limited and you can only have one of these loans, the strategy is to apply for the maximum amount. So how much loan can you qualify for? Well, the calculation is the lesser of your average monthly payroll costs multiplied by 2.5, plus if you have an outstanding disaster loan that you qualified for, less any advances that you received on this disaster loan, or $10 million, whichever is lesser. Average payroll costs are going to be based on the look back period of a year. Most people will probably use the 2019 calendar year, but you can use the last 12 months, say from 4/30/19 to 3/31 of 2020. If the applicant was not in business from February 15, 2019 to June 30th of 2019, they can use the period of January 1st, 2020 to February 29th, 2020 to calculate their average. Seasonal employers can use an average of either February 15th of 19 to June 30th of 2019 or March 1st of 2019 to June 30th of 2019. What payroll costs are included? We have cash compensation costs and we have non-cash compensation costs. And the cash compensation are the wages, commissions, salaries, cash tips, vacation pay, family sick leave, severance pay. So we add these up, and the combined cash compensation amount for any employee cannot exceed $100,000. For self-employed taxpayers, the net earnings from self-employment up to $100,000 can be considered. To this cash compensation, we're going to add the non-cash compensation, retirement benefits paid by the employer, group healthcare benefits, state and local tax, and the compensation paid to employees. I have a single member LLC client. She has five employees. We're going to use the cash compensation piece, the wages, to calculate the amount for her employees. And then we're also going to submit a Schedule C, a 2019 Schedule C, that shows her self-employment income. Okay, what payroll costs are excluded? Compensation over $100,000 for any given employee. Employer portion of payroll taxes. Compensation for an employee who resides principally outside the U.S. Say your main business is located inside the U.S., but you have a subsidiary that's located in, say, Poland. So you have 20 engineers working in Poland that you pay wages to. Well, the wages you pay to them employees in Poland will not qualify for this, and you will have to exclude them from the calculation. Also excluded are qualified sick leave wages and Family Emergency Act wages that you received the credit for already. Also excluded are payments to independent contractors. Early on, it was believed that payments reported on 1099s would count as wages. The Treasury has since provided guidance on this, stating that independent contractors could qualify in their own right for this loan, so letting businesses include this payment would be double counting. Let's take a look at what this calculation looks like. Here we have a business with 3 employees. We have a look back period of January 1st, 19 to 12/31 of 19. And we have wages totaling $385,000. We have one employee that exceeds the $100,000 cap. So we have to only include $100,000 for that employee. So we total up these amounts, and our amount is $235,000. But we also get to include the non-cash piece. We have some health insurance, we have some health savings account that we pay, and we have a defined benefit contribution that we make on behalf of these employees. So we total that up and we have $309,000. We divide that by 12 to get our monthly average, and we multiply that by 2.5 to come out with our maximum loan amount of $64,439. Okay, now that we calculated the loan amount, we need to apply for the loan. So on the loan, you're going to have to certify um, several different things. One of them is going to be that you're applying for this loan because of the current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. You're also going to have to certify that the funds will be used to retain workers and maintain payroll or make mortgage interest payments, lease payments, and utility payments. There's going to be a variety of other certifications that you're going to have to make. It depends on the bank. Each one of them's loan application is going to be a little different. Again, I want to point out that this is an SBA loan that you're qualifying for. Make sure that you fill out the paperwork correctly. After the bank gets approval from the FBA, they're going to draft up the loan documents for you to sign, and then they're going to fund your loan. Once the loan is funded, you need to use the proceeds of the loan. Okay, acceptable uses of the funds are payroll costs, as previously defined. We have, the cash payroll costs, the compensation wages, the healthcare benefits, the other benefits allowed. You also have your interest that we're going to be allowed to take, the rent, utilities, and potentially there'll be some other costs put in there as further guidance is done and they revise this program. On the interest piece, notice that it's the interest on the mortgage obligation and not the principal. They're not going to allow us to use these proceeds for any principal payments. And also notice that it's for loans incurred before February 15th. They're not going to allow you to take out a new loan and use this program and have that loan forgiven. Okay, let's look at the loan forgiveness feature. So once you have received your loan, there begins an 8-week forgiveness period. During those 8 weeks, if the loan is used for its intended purpose, the payroll costs, the rent or mortgage interest, and utility costs during this period, the loan will be forgiven for this amount. Also, there's going to be no cancellation of indebtedness income or COD income for the amount forgiven. But however, at this time, it is not exactly clear whether the expenses paid will be allowed as a deduction. And if this is the case, this would essentially be a loss of allowing the COD income not to be taxable. But since it looks like the intent of Congress is to make this COD a non-taxable event for the borrower, the thought is that further guidance will be issued to clarify this and hopefully make the result is that the COD income is not taxable and the expense is allowed as a deduction. Okay, so the borrower must apply for the loan forgiveness and be able to substantiate that the loan proceeds were used for the purposes listed above. And it's going to have to certify the correctness of the information and of the uses of the funds. This is where the importance of the clean accounting and good record keeping will come in. We don't exactly know what each bank is going to require from the borrower. But we know they're going to need the underlying paperwork, and we know that you're going to have to be able to prove that the money came from the funds, the borrowed funds. So we still suggest that you have a separate bank account if available, put the money in that bank account so that it's very clear that the loan proceeds were used for the qualified expenses. If you don't have that separate bank account, then you got to make sure that your check register is very clear, at least for the 8-week period. Make sure that the 8 weeks of the register has clear descriptions that, especially if you have a lot of other transactions that are going in and out of that bank account, it's going to be important that you can identify these expenses. We want to make sure that we can get every qualifying expense of this loan forgiven. And since this program is all about keeping employees, the forgiveness is going to be reduced if the borrower reduces their headcount during the 8-week period. You need to maintain the employee equivalent count at the previous level, or the loan forgiveness will be reduced by the percentage decrease. Also, you need to keep the employees' wages at least 75% of what they were back in February are the loan forgivenesses reduced by the same amount. And for the loan total that you received, at least 75% of the loan proceeds must be spent on salary. The remaining 25% can be spent on other qualified expenses, the rent, utilities, interest, etc. One caveat here I'd like to point out is that this is one of the items in the proposed stimulus 3.5 package, whereby they may allow these expenses to exceed the 25% limit. But remember, this bill is not final, and it's most likely going to end up being different than how it is now. So, whether it stays at that limit or not, we'll have to wait and see. So, say you're an employer that had to shut down their complete business. You're a non-essential business. You're completely shut down. You made the decision to let your employees go. So you're thinking, well, you can't maintain that employee equivalent count. You don't have any employees right now. Well, you can restore yourself and get the loan forgiveness if you hire your employees back or hire new employees to the pre-February 15th level by June 30th of 2020. So what would the forgiveness look like? So for the 8-week period, remember we had a maximum loan amount of $64,000. We pay wages of 75% of that amount, $48,000. Say our rent for that 8-week period is $10,000. Say our other expenses during that 8-week period is $8,000. So we have total qualifying expenses of $66,000, maximum loan amount of $64,000. Our expenses exceed the loan amount, so our ending loan balance would be zero. So that's the end of my presentation on the Paycheck Protection Program. I hope this answers any questions that you have. If you do have further questions, feel free to reach out to me or any of your other LIMI advisors. Thank you and stay safe. And now I'm going to turn the presentation over to one of our tax managers, Jeff Ewan, to continue with the presentation. Thank you.
Thanks, Brian, for that great information on a much talked about element, the most talked about element of the CARES Act, the Paycheck Protection Program. I'm sure there'll be more to come on that as we get more guidance. So I'm here to talk about a couple additional loans and other relief that's available to small businesses. Some of the loans I'm discussing, most of the loans I'm discussing are in existence, but perhaps have some tweaks under CARES or some additional elements. The first of those is a disaster loan, which again is not new. Those are in place and reserved for qualified disasters, which we find ourselves in right now under COVID-19. So this particular disaster loan is available from January 31st, 2020 through December 31st. These loans, disaster loans in general, are direct from the SBA, can be up to $2 million, 30-year terms, 3 3/4 interest rate for for-profit businesses and 2 3/4 for not-for-profit. No personal guarantee required if loans under a certain amount. No collateral, or I should say collateral might be required, pardon me. And the proceeds of the loan are used for operations. The eligible borrowers are those businesses with less than 500 employees, including self-employed persons and not-for-profits. If you secure a disaster loan, it can be refinanced into a PPP loan if you secure one of those subsequent to the disaster loan. So, we're in a scenario here where timing may be important. A lot of people have, businesses that is, have applied for the PPP loan. They're waiting to hear back. The disaster loan may turn around more quickly, and so potential lenders may be encouraged to apply for both. If they secure the disaster loan first and then subsequently get the PPP loan, you can refinance the disaster loan into the PPP loan. Alternatively, you can have both. It's just that you cannot use the funds, the proceeds from each for the same purpose. So we kind of have a narrow definition of what we can use the funds for the PPP loan, right? That being primarily wages, payroll, and rent. And so if you wanted to have both, you couldn't use the 7B2 disaster loan proceeds for those same purposes. So one of the elements that came about via CARES with respect to the disaster loan, this is new for CARES and specific to the COVID-19 situation, is an emergency advance of up to $10,000 per applicant. So you can apply for the disaster loan and also request you want $10,000 right away. It's supposed to come within 3 days. Based on some folks on Twitter and their contributions, I don't know if it's played out that way. It doesn't sound like it, but that was the design. So in any event, provided that that $10,000 is used for these expenses listed here, sick leave, payroll, rent, mortgage, and other debt, other existing debt, then you don't have to pay back the $10,000 advance. Further, if you apply for the disaster loan and you don't get it and you've requested the advance, you don't have to pay it back either. So a nice feature of the disaster loan under CARES. Now, there's some confusion this week and we're recording this on April 8th. On April 6th, the Massachusetts District of the SBA posted an FAQ on its website that indicated that the advance is based on number of employees, and it's $1,000 per employee up to 10 employees, $10,000. The accounting community was a little confused and is a little confused because we haven't seen that elsewhere, and we did not think it was based on the number of employees. So we'll need some clarification, some guidance on that, and we'll be monitoring that closely. We should note that if the disaster loan is refinanced into a PPP, then the $10,000 advance, if taken, reduces the amount of the forgivable portion of the PPP loan. So another loan that's been around, and it's another type of disaster loan, is the Express Bridge Loan Pilot Program, so the EBL. And again, this exists under the SBA Express program. This particular loan for this particular disaster is available March 25th, 2020 through March 13th of 2021. And it's available to small businesses. Now, small, the size is dictated by the industry size standard of the SBA. Maximum loan here is $25,000. As we said, it's a bridge loan, so a smaller loan. Max term of 7 years. Designed to have a streamlined underwriting process. The idea here is to get this $25,000 in the hands of small businesses as soon as possible. No collateral required, and the borrower must pledge that the proceeds are used to support the survival and or reopening of the small business. And this loan can be refinanced into a 7B2 disaster loan. Now, the rub on the EBL loans is that it's limited to limited borrowers, right, and limited lenders. So first of all, not all banks do SBA loans. Not all SBA loans do EBL loans because they have to be SBA Express lenders. And further, if you are an SBA Express lender, you have to have an existing relationship with a small business in order to make one of these EBL loans. So kind of a narrower path on this one, but maybe worth reaching out to your lender, your bank, to see if they participate in this program. So let's not forget about traditional SBA loans, right? Those are still available. Certainly when compared to the PPP loan, PPP may be more attractive because it has a forgiveness feature. But two things. One, if the funds get gobbled up, even the new funds that are slated to be approved as early as tomorrow by Congress, then perhaps a traditional SBA loan is a good route for you. Loans up to $5 million, the terms are typically tied to the use of the proceeds. So, for real estate, 25 years, probably more likely in this scenario, we're talking about operations, maybe 10 years, or if you're purchasing equipment, tends to be tied to the useful life of the asset. Interest rates, I'm hearing from some SBA loan contacts that we're looking at prime plus a margin, that margin being somewhere in the 0 to 2.75% range. And these loans are primarily guaranteed by the SBA. A few other SBA loans to note, and more noting for purposes of the next slide, we'll talk about a element of the CARES Act. So these loans are not new either. 504 loans are primarily for fixed asset acquisitions and construction projects up to $5 million. The loan proceeds. Oftentimes, or I think the borrower does have to put down 10% collateral, so perhaps not as attractive in the current environment. Then microloans, these are smaller loans up to $50,000, and the terms are specific with the given lender. Just can't be used to pay existing debt. So one element of the CARES Act that's applicable to these 7A SBA loans, other than the PPP loan, is that the SBA will pay 6 months of principal, interest, and fees on existing and newly secured loans under 7A in light of COVID-19. So through September 27th of 2020, you secure a loan between now and then, you get 6 months free basically on the loan. All right, so some other relief opportunities. This one's maybe a little bit more personal in nature, not necessarily personal to me, but to like the individual taxpayer versus a business. That lenders, so more for home mortgages, certain banks are offering a 90-day relief from mortgage payments. So that may be worth reaching out to your lender to see if they're participating in that program. And even if you're a small business owner, checking with your lender to see if something similar exists there, that might be helpful in terms of freeing up some cash in the near term. So we've talked primarily about federal relief opportunities so far, but California has some as well. So on April 2nd, Governor Newsom announced a series of initiatives to help small businesses in California. One of those is the Small Business Disaster Relief Loan Guarantee Program. $50 million is put towards this program. It's primarily for microloans. And eligible businesses are those with 750 employees or less that have been impacted by COVID-19. Nonprofits are eligible as well. 7-year terms for the most part. Interest rates are negotiated with the lender. These are primarily for the continuance of a business, right? And so we're talking again about rent and payroll primary expenses that would be used with the proceeds of this loan, or would pay for by the proceeds of this loan. And I have a link down there below if you're interested in pursuing more information on that. Another California relief option is via the California Department of Tax and Fee Administration. And so any filings and payments that were due March or are due in April have a 90-day extension. So March deadlines extended to June, April deadlines extended to July. And that's for returns with less than $1 million in tax. If you have more than $1 million in tax on a given return, you can apply for an extension, and the department will review those on a case-by-case basis. And so what taxes are we talking about? We're talking about sales and use tax, probably the main one. But a couple other examples here: alcoholic beverage tax, the motor vehicle tax. And if you want to click on those links below, that'll give you an exhaustive list of the taxes that are impacted by this relief. So a little more on sales and use tax for small businesses that have $5 million of taxable annual sales or less. They're eligible for a $50,000 deferral on sales and use tax, and that deferral is for 12 months interest-free. I looked today, I didn't see that online application, but check back if you're interested in pursuing that. And finally, want to talk about a local opportunity now. Unfortunately, this one, for the time being, seems to have been all gobbled up by small businesses. There were 6.1 million available under the Small Business Relief Fund. It went online March 27th, and I think by the 31st, it was they'd received more applications than they had funds for. Maybe even quicker than that. They are accepting applications still, but certainly, given that note with respect to the funds being all spoken for, potentially that might not be a high likelihood of securing one. So that is all for the additional loans, California relief, and local relief. And I'd now like to turn it over to Jen Glazier for some closing remarks.
Thank you, Jeff. As Jeff and Brian have gone over today, there's a lot of great loan programs out there that you can apply for assistance for your business. They're pretty complicated, so we expect questions. Reach out to us, email, call us. We're standing by to assist you understand how these loan programs may benefit your business. We know that you're frustrated with this PPP loan program. It hasn't rolled out smoothly. We still have a lot of questions, but we're here to assist you and guide you through all of that. And as Jeff has mentioned, there are some other loan options, incentive options that may help you if you're not able to obtain that Paycheck Protection Program loan. So those are other options that we can kind of guide you through. So thank you so much for tuning in today. We hope that you're happy and healthy from our family to yours. We look forward to serving you and talking to you soon. Thank you.